Good day and welcome to FinChat Podcast, where we interview professionals in the finance industry to allow them to share their experience and knowledge and to educate and expose the next generation of business people and entrepreneurs to the world of finance, banking and related topics. I am Joshua Prince, and here at FinChat we recognize experience in business as a resource to learn from, and we try to harness that resource as best as possible. Today, we're back with the third part of our real estate investment series with Attacq CEO, Hamman. If you missed the previous two episodes where we discussed Mel's journey to becoming CEO of a JSE-listed real estate investment trust, or the episode where he walked us through the technical process of property financing and investment decisions, please go check them out. They are truly insightful conversations. Also make sure to check out the FinChat Instagram page for bite-sized technical infographics to help you understand that lingo a bit better. Okay, Mel, so since the beginning of 2020, the SA listed property index has dropped a whopping 47% from 448 points to closing at 238 points at the time of this recording. And this is obviously due to the impact of COVID-19, and it has become more apparent when the threat of COVID-19 actually came to our attention, especially since the start of March 2020. What has been the main driver of this extreme downturn, and what was the actual impact of COVID-19 on the property industry?
It's a good question. Maybe to take a step back, you're talking about indexes and percentages. I'm just going to give you some rand and cents numbers to that. So if you look at, call it in SA on the JSE, there's about 35 listed REITs. If you look at the top 20 REITs, if you look at the accumulated market cap, I'm going to use March 2019 as a number. So in March 2019, the accumulated market cap was 315 billion rand. And then a year later, it was 140. And so it has lost about 170 billion rand of market cap. Okay, my dad will always say, but it's an unrealized loss because you haven't sold anything. But some of our asset managers have sold because they need to buy and sell based on their mandates. Then also quite an interesting number, which some people also don't realize, is between those top 20 REITs, they own, call it real estate or property of close to 600 billion rand. Okay. Then against the 600 billion, they've got debt of about 218 billion. So if you take 600 less 218, it's about 300. So the number is actually 576 billion and 218. So their NAV, it's give or take 360 billion, and the market cap is 140. And that talks to a massive discount between share price and actual book value. So now the question is, why have we reduced so substantially, and why are we trading at a discount? Okay, so why we have reduced, and again, it talks to why are you investing into property, or why are you investing into any asset? It comes back to the total return. Total return is a function of your view on capital growth and your view on future income. Now, the view on future income is much more negative than pre-COVID, because you are sitting with so much uncertainty, you just don't know. So if you do run a DCF model to determine the value of any REIT, then your discount rates will be higher, and also your income will be lower, and that's why your present value will be less. And then also, if you look at the capital growth, you will then, because also what people don't realize is what has happened in the last 3 weeks. We've been downgraded by Moody's into sub-investment grade, or call it a junk status. We've been further downgraded by Fitch as well as S&P. So we've been downgraded with 3 rating agencies. And then globally, you will take a much dimmer view of investing into SA. So then funds will flow out of SA and you will have more sellers than buyers, and then that will put pressure on the price. So coming back to the REIT sector, why our share prices has reduced, I would say one, there's a question on values, and the question on values again sorry, talks to the outlook of the economy. And as you know, the outlook on the economy now, it's much more negative than 5 weeks ago. I think some of the economists are talking about the GDP growth of minus 6%. Okay, so that is an issue for us. It's your capital. What is your day one capital value, and what will the growth be on that capital value? And then secondly is, what is the present value of your future distributions? So you're spot on. I mean, the REIT sector has taken quite a big hiding from a share price viewpoint, but it talks to the uncertainty. Maybe just a last thought on that. We actually did a graph a time ago and say, with what correlates a REIT share price? Does it correlate with long bond yields? Does it correlate with prime? Does it correlate with inflation, GDP growth? And then quite interestingly, the highest correlation was with business confidence indicator, with a BCI. So again, the business confidence indicator for SA is extremely negative. If I remember, I haven't seen the latest one, but if I remember correctly, I think either Jan or Feb, the BCI was the lowest since 1994, if I remember correctly.
Yeah, I remember our lecturer told us it's worse than the 2008 crash. And that makes sense because I mean, property as you said when you did your risk analysis, that when you invest into an asset, you invest into a lease also, and it's underlined by a tenant. And if your tenant doesn't have business, you can't have any business. So, I mean, you're at high risk to the risk of your tenants.
To COVID and the impact of COVID. What we are saying, and we refer to COVID as an event. So we said this event is from an economical viewpoint and a social viewpoint, it's a crisis. Unfortunately, none of us, government, the banking industry, property owners, there's a lot of uncertainty, and we don't know. It's difficult. It's actually, I wouldn't say impossible because we've done it, but it's difficult to quantify what the financial impact of this event will be. So what we are saying is, if you look at the event, we sort of split it into two. We say one, there's a period of disruption, and we are currently in that period. We are level 5, 4, 3, 2, 1. So that is all your different levels of disruption. And then once we're into one, there's going to be a period of recovery. Now that the challenge is, all of us, all of us in SA, we don't know how long and deep this period of disruption will be, and we don't know what the recovery period will be. And that talks also to the uncertainty in the system, the uncertainty on our future rental income. And then if you look at the different asset classes, I mean, retail is definitely a question. What will happen with retail? And then what we are saying is, if you look at retail, you must also look at the underlying different types of retail. You've got the food retailers, and call it the pharmacies. They've done exceptionally well during level 5, and they will continue doing well. Then the next, call it the category of retail is your clothing retailers. And the clothing retailers, I think during the disruption, they've battled, and then the recovery period will definitely be longer. I mean, and then I think you guys are close. You maybe have seen the information around Edcon, but Edcon is going to put themselves into business rescue, and they say at the end of the day, it's also on the back of COVID-19, because they've lost turnover, they've lost gross profit. So it's, and then your second or your third category of retail is your furniture retailers. And then you can say the next category of call it retailers is your motor car industry. And each one of those different types of retailers will have different recovery period. So the reality is, coming back, your business confidence indicators are low, and the outlook on the economy is extremely negative. And also, we don't know what the tenor will be of this period of disruption and the recovery period. For instance, I've listened to a webinar last week, some information in the States. They said, for instance, in the hospitality industry, the hotels, the recovery period might be as long as 3 years.
Yeah, I mean, no one wants to go into public spaces, I think. And what do you think? Do you think, specifically to REITs, globally or even locally, do you think that what the portfolios consist of, would that change? Do you think retail exposure is going to decrease because of things we saw like COVID, where public spaces and things are becoming a risk area for people, even if it's just mentally or not really there? Do you think it will affect how REITs set up their portfolios?
I would say, if you look at the REIT and if you look at the success of a REIT, it's twofold. It's one, what is that REIT's capital structure? So what's their debt to equity levels? And then secondly, what sits in the underlying portfolio? So let's say you've got an excellent portfolio, but your debt levels are too high, then it's a challenge. Or if you've got your capital structure is excellent, but you're sitting with a weak portfolio, then you also do have a challenge, or you can start selling your weaker assets. What we have seen, and coming back closer to Attacq, the fact that we've got a diversified portfolio is to our benefit. Our rental income is split 50% retail, 50% non-retail. From a collections viewpoint, and we have put out a SENS announcement on this, from a collections viewpoint, we've only collected 62% of our rent during the month of April. And that 62% is then split. It's our average collections rate. If you look at the counterparts, and again, it's a global number. The global number on the retail side, it's between 35 and 40% you've collected. So if you are 100% retail fund, then you've only collected 1/3, where if you're sitting with a diversified portfolio, you've collected 60%. So we sometimes use the word blessed. So from an Attacq viewpoint, we're blessed that we diversified. So if you ask me, Mel, will some of the other REITs also now diversify? It's difficult to say, because it's definitely not the time to purchase any assets. Because all of us are so focused on our own liquidity and our own collections. And also, if you want to purchase an asset, what we've normally done up until now, you will purchase that asset by raising new equity and by raising debt. But if your share price is trading at a 60% discount, then you don't want to raise equity.
Yeah, that makes sense. The access to finance, and I don't think, would the banks be willing to loan out borrowings now also?
Yes, but again, it will depend from counterpart to counterpart, to borrower to borrower. If you are currently sitting with excellent liquidity, a good portfolio, fairly low gearing, then they will definitely advance to you. If you're a counterpart with high gearing, you're illiquid, you've got cash flow issues, then they say, no, I'm not going to advance.
Yeah.
So again, it depends from counterpart to counterpart.
Yeah, that makes sense. Yeah, and so now, as a CEO of a listed property company, what has been the hardest challenges that COVID has brought over your life and the company?
It's to keep your stakeholders calm. And stakeholders, per definition, it includes your shareholders, it includes your bank, it includes your colleagues, it's your tenants. So over the last 4 weeks, 5 weeks, we have had a lot of engagement with a lot of our stakeholders. I mean, from an Attacq viewpoint, we've got over 900 tenants. So we've been engaging with our tenants, I want to say, on a daily, weekly basis. We've got 9 funders. We've been engaging with our funders every second week. We've got 150 staff members. We've been engaging with them on a daily basis. From a shareholder viewpoint, we've got about 7,000 shareholders. What we've done over the last couple of weeks, we've issued 2 SENS announcements. So as a listed entity, that is the best channel to, let's say, liaise with your shareholders, especially if you communicate potential price-sensitive information, then you have to do it via a SENS announcement. So, and it comes back to the word collaboration that includes communication. I think during this period, it's extremely important to collaborate with all your stakeholders.
That makes sense. And so let's go down to the final questions, also just short ones that came from the students when I told them I'm going to have an interview with you. So one of the questions was, if you were a student today and wanted to learn anything about real estate investment and even considering a career in it, how do I start learning from to be in this industry? And even if I have spare cash, how do I take advantage of this crash, if I can call it that, and start to build our own
I would say, Joshua, what
portfolio?
we've done, and we've covered it in our first session, it was sort of your opening statement where you attended one of our results presentations. So I think as a student, definitely learn more about the industry, learn more about the entities operating in the industry, and see if you can attend results presentations. If you reach out to the investors relations person, it's highly unlikely that they're going to say to you, you can't attend, because we've always booked, let's say, for 120 people and only 100 pitch. So there will always be a spot for you to attend. And you can either send me an email and I can arrange for you to come and attend one of our sessions. So it's definitely learn as much as you possible about the industry, the companies, and the asset classes. If you talk about investments, there's a lot of platforms which you can invest into the JSE. I think the cheapest one is Easy Equities. And quite interestingly, Easy Equities, you can buy, for instance, 100 Rand of Attacq shares, and then you will buy 20 shares or whatever. So Easy Equities, if you've got a bank account, most of the banks do have an electronic platform, so you can definitely buy via that. You must just make sure that your monthly admin costs are not too high. So to some extent, it doesn't make sense to buy 1,000 Rand of shares and then your monthly cost is 48 Rand. Then you're definitely not going to make a return.
Yeah.
And then there's a couple of unit trusts that are focusing on specifically on REITs, so you can buy into one of those unit trusts. Personally, what I've done for myself and my kids, I've opened up for each one of us that I call it a TFSA, a tax-free savings account. And then via the tax-free savings account, we invest only in property. And the reason for that is because you're not taxable, or you don't get taxed on your distributions. So that's all then ring-fenced in that TFSA product. So I would say if you want to invest into a REIT, then invest into one of those TFSA products, because then there's a tax benefit for you.
Yes, that tax-free savings account is definitely a great option to start off with, I think, for any young person. Also because you have none of the capital growth is taxed, none of the dividends are taxed, none of the interest even that you receive get taxed. So it's really a fantastic place. And also think that place that started the Easy Equities company also started a platform now called Easy Properties, where you can buy fractional property now as well. Yeah, I thought that's quite interesting. All right, thanks, Mal. I think that concludes it for this property series. Thanks so much to all the listeners. I really appreciate the support. Thanks for listening to this FinChat. Remember, we learn from repetition, so please share with your friends and have discussions around what you've learned. And we'd love to hear your thoughts and recommendations, so write to us and give us a follow on LinkedIn. You've been listening to FinChat Podcast. I am Joshua Prince. Until next time, goodbye.